Welcome to RBC's Markets in Motion podcast, recorded July 2nd, 2025. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we review the bull thesis we heard in our investor meetings as 2Q came to a close, and our thoughts on where it could go wrong. Second, we review how the rally in equities has been looking a bit overdone on our valuation and EPS work, and how we're also starting to run out of room on one of our sentiment studies. Third, conditions are rather mixed for U.S. equities at the moment. We walk through what looks good and what looks not so good. If you'd like to hear more, here's another 8 minutes. We know it's a little longer than usual, but there's a lot on our minds as the second half gets underway. Plus, the podcast is taking next week off. Now let's jump into the details. Starting with takeaway number one, the rapidly evolving bull thesis. We ended 2Q on the road seeing institutional U.S. equity investors in a few different states. While it didn't appear to us that they were uniformly bullish on U.S. equities, some came across as downright excited, and most of those who had been more tempered in their outlooks appeared to be talking themselves into a more bullish stance. It was striking to us how much the bull thesis on U.S. equities changed in June. Back in mid to late May, what we heard in client conversations was essentially that the stock market had already paid the price for any tariff-related impacts on inflation and the broader economy, and that tax cuts and deregulation would be stimulative in 2026. As a result, many argued it made sense to ignore any 2025-related potholes to tariffs and to look ahead to 2026. While tax cuts and deregulation are still seen by many as stimulative, the focus on tax in particular has narrowed, with many investors making the case for a ramp-up in CapEx spend due to some provisions in the tax law. This has gone hand in hand with a high degree of bullishness on the already extremely expensive industrial sector. The cooler inflation data that has been seen recently has also caused many investors to believe there simply will not be any inflationary impact from tariffs, and several also expressed doubts about any adverse impacts on labor or the broader economy. Instead of displaying a willingness to power through any tariff-related potholes, U.S. equity investors are gravitating towards the idea that there simply won't be any potholes. Anticipation of Fed cuts boosting stocks was something else we also heard a fair amount of as 2Q ended, which hadn't been as prevalent in our May meetings. The benefits of a weaker dollar on earnings were also in focus for some, and we'd estimate that about half of the U.S. clients we spoke with in late June were excited about AI again, echoing the enthusiasm for the U.S. AI productivity theme we'd heard in our non-U.S. meetings several weeks ago. To be fair, not everyone we spoke with at the end of June agreed with this rosy assessment, and we spent plenty of time as 2Q wrapped up discussing with some investors how much pre-tariff inventory companies may have on hand and when that's going to run out, whether the pull forward of demand will generate some weakness in future demand and corporate revenues and earnings, and whether companies will pass on prices or absorb tariffs, along with whether any tariff-related potholes are just being pushed into next year, delayed but not disappeared. Overall, we ended 2Q thinking overall conditions in U.S. equities didn't seem quite frothy yet, but we're headed down that path. We also exited the quarter with a clear list in our head of how U.S. equities could get derailed in the back half of the year. If we do end up getting some inflation pressure or broader economic potholes from tariffs, or if the Fed doesn't cut after all, we think it's going to come as a negative surprise to many investors. If inflation impacts or broader economic potholes simply get pushed into 2026, we think it's going to dent the optimism on next year that seems to be pulling in even the more cautious folks. Moving on to takeaway number two. The rebound is starting to feel full from a few different vantage points. One of the points we've been making in our meetings is that while we understand the stock market's fierce rally from a sentiment perspective, it has been feeling a bit overbought to us from a fundamental perspective. Our earnings and valuation work, which bake in a stagflation environment with real GDP in the low 1% range, inflation in the high 2% range, 3 Fed cuts, and 10-year yields that fall below 4% by year-end, point to a fair value estimate for the S&P in December of 57.30. With a slightly more optimistic EPS assumption, one in line with the current consensus that's tracking at 265 as opposed to our own forecast of 258, our modeling moves up a notch to 5,900, but it still falls short of current levels in the S&P. Inspired by our conversations last week, we put together a new stress test for our valuation model, baking in inflation that falls to 2%, just one Fed cut, 10-year yields that remain at current levels, and an EPS assumption of 270, higher than the bottom-up consensus is right now. That math still only gets us to 6,200, right in line with where we are today. We've also been pointing out in our meetings that at the time of our last price target update in May, our sentiment work was making the case for the S&P 500 to move a bit higher, perhaps up to 6,400. That model is based on net bulls in the AAII survey, and to be fair, there is still room for that indicator to move up before hitting levels, one standard deviation above the long-term average, that have foretold the tops in the stock market since 2022. But when we put the rebound in the context of other moves off of extreme lows, it's starting to look like there's just less room for upside from here. We've analyzed how the S&P 500 tends to trade 9 months after experiencing major non-recession drawdowns since the GFC, the pullbacks of 10% or more ex the COVID recession rebound. That's essentially a time frame that approximates the window between the April 8th low in the S&P and year-end 2025. What we found is that the average 9-month rebound has been 26%, which this time around would take the index up to 6,270, not too far away from where we are today. At this point in time, with a 25% move off the low as of Monday's close already in the books, the rebound off the April 8th low is also trading hotter than all of the other rebound trades we've studied. Wrapping up with takeaway number 3. Conditions seemed mixed. Here's a rundown of the good and the not so good that we're seeing in our weekly deck. Let's start with the good. Bottom-up consensus 2025 EPS growth rates and 25-26 operating margin forecasts for the S&P 500, if you look at the bottom-up consensus, have stabilized. As our clients noted, the weaker dollar should be a good talking point for companies in the upcoming reporting season. Small caps, a key risk barometer, are still in net short territory on the weekly CFTC futures positioning data, which points to oversold conditions in riskier assets. Expectations for Fed cuts have also deepened, which tends to boost equity prices. The positive inflection in consumer confidence did hold up in the latest Conference Board survey, despite ticking a little lower relative to the prior month. And views on the policy backdrop ticked up a little bit higher in the University of Michigan sentiment survey. The equal-weighted S&P 500 does still have some room to move up before hitting recent highs, which makes the case for broadening in leadership, and U.S. equity flows are holding up. Even though passive retail flows are softening, institutional passive flows are picking up. Meanwhile, at the time this podcast was recorded, the tax bill that's been at the center of equity investors' bullish market view has been making progress in Congress, though we do worry this is largely priced into stocks already. On the topic of the tax bill, it's interesting to note that the U.S. equity market made a major peak about a month after the passage of Trump's first tax package at the end of 2017. Moving on to the not so good. The rate of upward EPS estimate revisions for the S&P 500 is already back to post-COVID non-crisis rebound highs, making us wonder if this is as good as it gets for the 2025 earnings outlook. Bitcoin prices, which tend to move in sync with the S&P 500, have also stalled, which makes us nervous about risk assets generally. The market cap weighted median PE of the S&P 500 has also returned to more than 25 times, which is close to its pre-COVID high and adds to the case for a broadening of leadership near term. Meanwhile, 2Q25 GDP forecasts have moved up sharply, but we haven't seen the same kind of improvement in 3Q or 4Q25 forecasts. Even more importantly, we got further evidence recently through the Richmond Fed Duke CFO survey that the C-suite has not experienced the same kind of positive inflection and sentiment that has been seen in recent consumer, small business, and investor sentiment surveys. This is the third major C-suite survey that's come out recently that has seen C-suite sentiment deteriorate. One thing we like about the Duke survey is the ad hoc topical questions they ask. This time they probed tariff views where we saw evidence that CapEx plans for many firms have been impaired due to tariffs, and that many companies do intend to pass through higher prices, particularly those in manufacturing. This survey, along with the fact that there just hasn't been much attention given to tax cuts in this year's corporate earnings calls, did not leave us feeling good about the assumption of many of our clients that CapEx is on the cusp of booming and inflationary impacts from tariffs are not coming. The recent ISM release gave us the same impression, as new orders remained weak. When we exclude the top 10 market cap names in the S&P 500, trends in ISM new orders do tend to lead actual CapEx spend by about a year. If the C-suite were getting ready to do a big wave of CapEx, we'd expect to see ISM new orders moving up. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.